session. This is Professor Farhat. In this session, we're going to record sales under a perpetual inventory system. So when we make a sale, we could make a sale either on credit, which is accounts receivable, or we can make a sale and receive the cash immediately. Sales revenue, or like service revenue, is recorded when the performance obligation is complete. So once we deliver the product to the customer, pretty much once we transfer it, our obligation is complete when we're selling something, generally speaking. Sales invoice should be supported with credit. Sales invoices should support each credit sale. So when we make a sale, credit sale, we should have a sales invoice. Now we are on the selling end of things. Now we are selling product. Now we are the sellers. Okay. So notice here we have an invoice, and this is the sales invoice. So notice we sold one item of printed circuit board prototype, and we sold 5 items of production model. Again, there's the shipping terms, there's everything. But now we are dealing from the seller side because we looked at the buyer. Now we're going to be looking at the seller. Now, when we sell using a perpetual inventory system, we have 2 entries to make. First, we have to make the sale. So when we sell, we either debit cash or debit account receivable and credit sales revenue for the selling price, whatever we sold the item for. If you remember my let's assume we sold the calculator for $15. That's what we do. We're not done yet. We have 2 entries to make. 2 entries. The second entry is to record the cost of the sale. Let's assume that calculator cost us $10. So we debit cost of goods sold, and we credit inventory. We credit inventory for $10. And this is the cost of the sale, and this is for the cost. What did that $10 came from? This is how much I paid for the calculator. So I paid $10 and I sold it for $15. So when I sell it, I have to record the cost. So let's take a look at this example. PW Audio record the sale of 3,800 to SOG Stereo on account as follow. And let's assume PW Audio paid 2,400 to buy those products. Before they sold them, they have to buy them, obviously. Okay, so let's record the sale. First, debit account receivable, credit sales for the 3,800. Easy. We're not done yet. We have to record cost of goods sold. Remember, in a perpetual inventory system, our inventory is constantly updated. So that's why we have to update cost of goods sold, and our inventory is also constantly updated. Therefore, we have to credit inventory. So this is the entry to record a sale on account using a perpetual inventory system. So what happened if the buyer did not like the product, they returned it, or if they don't want to return it, they say, they were not happy and we gave them an allowance. So basically, the sales return is when they return the item. The allowance is when they keep it, but we give them a reduction in the price. Just like purchase return, a sales return is the flip side of a sales. So flip side of the purchase return and allowance. So basically, what we're going to do something very similar with a slight modification. We're going to debit an account called contra revenue, which is called, the type is contra revenue. We're going to debit an account called sales revenue. So rather than debiting, we don't debit sales. Do not debit sales when you make a return. So we don't debit sales. So we're going to flip it, but slightly differently. We're going to debit instead sales revenue. So sales not reduced, because it would obscure importance of sales return and allowance as a percentage of sales. Why not? Because we want to know if we sold 100 of merchandise and the $20 were returned, we need to know that 20% are returned. So we want to know this information and could distort comparison. So you want to see what was the sales, what was the return from period to period. So that's why we keep them separately. So let's go ahead and work this example. Prepare the entry a PW Audio would make to record the credit for return goods. Notice now they actually returned them that had a $300 selling price, and assume a cost for PW of $140. So the buyer did not like $300 worth of merchandise that they purchased. That's fine. We can live with that. We're gonna get it. They're gonna give it back to us, and we're gonna assume it's still in good condition. The cost to us, this is the cost to PW. So they returned $300 of their sale, but the cost to us is only $140 because we bought them for $140. So let's flip it. So notice we don't only debit sales. We debit sales, returns, and allowances, which is a contra revenue account. Contra revenue. Contra revenue means it's the opposite of a revenue. We credit accounts receivable. we put back the inventory because now we have the inventory. We put back the inventory and we credit cost of goods sold. This is a purchase return. Now let me tell you what would happen if we have a sales, not return, if we had a sales allowance. Let's assume the same situation, except we told the customer, don't return the product. You are not happy with the product. Don't return them. Would give you a $300 sales allowance. So here, the customer did not return the product. Here's what's going to happen. You don't need this entry. If the customer did not return the product, you don't need to debit inventory and cost of goods sold. So this will be a sales allowance entry. Debit sales returns and allowances and credit account receivable. Make sure you know the difference between the two. Assume the returns were defective and had scrap value of $50. Now they gave it back to us, but they were damaged. We still have to debit sales returns and allowances $300. We still have to credit the receivable $300, basically increase sales returns and allowances, reduce the receivable. However, whatever they return to us, it's only worth $50 now. Although we paid $140, but now it's worth $50. So what we do is we put it back in inventory at $50. Basically, we took a loss, and we credit cost of goods sold only $50. So remember, originally it cost us $140, and now it's worth only $50. So we had a loss. Basically, we absorbed the loss of $90. Okay. So the cost of goods sold is determined and recorded each time a sale occurs. In what type of inventory system? Is it in periodic? No. Is it in perpetual system? Yes. In a perpetual inventory system, cost of goods sold is determined and recorded each sale. And this is what I'm talking about here. Every time I make a sale, let me go back here one more. Every time I make a sale, I debit cost of goods sold and I credit inventory. So both my cost of goods sold and my inventory are updated. Not only cost of goods sold, also my inventory updated. And this only happens in a perpetual inventory system. Sales discount. Remember, we had a purchase discount. Remember, the purchase discount will have another counterparty. The party that offer you that discount, guess what? They're gonna get less money. So offer to customer to prompt payment. It's a contra revenue account. Sales discount. This is a new account as a contra revenue. Now let's assume we made a sale. Let's assume anything. We made a sale for $3,500. The customer returned $300. So what's left is $3,500. They have to pay us. Now we gave them a 2% discount. Remember, we gave them a 2% discount. And if we take 3,500 times 2%, we're gonna give them $70 off the bill. Another way to look at this is 3,500, and they're only paying 0.98 of the bill, which they have to pay us only 3,430. Well, if they only pay us 3,530, 3,400, not 500, 3,430, we debit cash, 3,430, we reduce the receivable by the full amount. Now the difference, the $70, we call it sales discount. So we do have a sales discount. Sales discount is recorded, and sales discount is a contra revenue. Okay, sales discount is a contra revenue. Now I'm going to show you a relationship. So if we take sales minus sales discount, which is a contra revenue, minus sales returns and allowances, that formula will give us something called net sales. So in this example, we started with sales was 3,800, sales discount was $70, and sales return were $300. So let's see. So the net sales is 3,430. So make sure you know this formula. If you have any questions, any comments, by all means email me or see me in class. If you're studying